Thank you so much, Ravi sir, for taking out time, sir. We're really blessed to have you. Ravi sir, as everyone in the batch knows, has more than 20 years of investment experience. We are blessed to have ValueQuest as one of our recruiters. It's truly a privilege to have Ravi sir share his wisdom nuggets through the course of Stalwart series at Finacle. Sir, over to you, sir.
Sure. No, as I said, thank you so much for giving me the opportunity. And I must say, you are doing a wonderful job. Finacle is churning out ready to get employed students for the financial markets, and we have had few of those in our at ValueQuest as well. Dara is currently working, but in the past as well, Zaid has been there, and I believe one more was there if I'm not mistaken. So obviously, you guys are doing a great job, and I'm happy to be here. I will showcase my PPT, and but before that, I just want to say that feel free to ask questions. Is there a chat box where they can ask questions?
Sir, what we have done is the candidates who are attending the session, they went through your blog.
You collected
yes, sir.
questions
yes, sir. So I'll be moderating those questions on their behalf. And in case if they have any questions, they'll share across their questions on chat box with me, and I'll moderate those through again.
No issues. Then we'll go through the PPT first. Let me know if you can see my screen. Is my screen visible?
Yes, sir. Yes, sir. Yes, sir. Screen is visible now.
Yeah, sure. I'll just start in a moment. Yeah, so this is ValueQuest. We are based out of Bombay, Prabhadevi. We are a small PMS firm. So there are three sections in the presentation, but essentially one is about a little bit about ValueQuest. Second is about our philosophy, our framework, and our process. And the third is about I have a lot of practical insights into the markets, and I'm going to be, that is the main topic of the day that I'm going to be talking about. And feel free to ask questions if you have questions regarding anything during the presentation. Please make a note of it and send it across to Shailesh sir, and he will be passing it on to me. So without any further ado, I'll just start. And as always, whenever you start first, you have to give a disclaimer in our markets. So nothing in this presentation should be construed as an invitation to invest in a particular company or stock. Please refrain from asking any company specific question. I mean, I am happy to answer company specific questions, but not kya lagta hai. You have to be asking a business question and not a stock price question. Any companies, if mentioned, will be purely as an example and not a recommendation to buy or sell. And third part is the most important, which I find that a lot of people, they look for certainty and strong answers. If somebody even says a lie with a very strong conviction, people tend to believe. But if somebody gives a hedged answer, then it's not taken very seriously. But essentially, certainty and strong answers are illusions. This is a market. Market is a game of probability. So no one can be 100% sure. It is all a game of probability, and it is all a game of experience and making a decision based on those experiences. So yeah. So first we get into, as I said, the agenda is 3 about ValueQuest, VQ scale framework, and then practitioner's guide to investing. A little bit about ValueQuest. ValueQuest is a PMS with a 12+ year of track record. We also have a CAT2 AIF, which is a private equity fund, which is filed with SEBI. We are awaiting approval. We have current AUM is about $625 million, or in rupees, if I were to say, roughly about 5,200 crores. We have a return of 17.5% generated over the 12-year period. That is across the schemes that we run. But there are 2 main schemes that we run, and since inception, those both the schemes have generated closer to 20% kind of returns. We are a 15 people strong research team, and the whole organization is about 32-33 people. Sorry, did I hear anyone? Okay, I'll just move ahead. So what is VQ scale framework? Okay, I'm sure you guys know about me, have read about me, but I have learned a lot from Sri Rakesh Jhunjhunwala. So my framework is an adaptation of what I have learned from him. It is not necessary that I have exactly copied whatever he has said, but a lot of it comes from the way he used to think. And the biggest thing that if I were to say what I learned from him is you have to develop your own independent thinking. Don't depend on anybody's thinking or opinion. You have to have your sound logic, rational, and opinion based on the work that you have done. And then only you can say that you are an investor. If you are just going to blindly copy somebody else, that doesn't mean anything. So he had a framework as well. And from that framework, I have adapted this particular framework, which is scalable companies with sustainable competitive advantage, which are adaptive and are on a long runway with superior execution capabilities. So essentially, we are looking for companies that are going to scale up in a big way. We are going to talk in detail about each of these, what is essentially the scale framework. So scalable companies. Now, there are companies that are run by a single person. There are companies which in Indian terms, it is called a Lala company. It is, family run. Does not mean that a family run company cannot be scalable, but you need certain institutionalization of the organization. There has to be a structure in place. There has to be a team in place. There has to be a strategic team as well as an execution team. The companies need to have strong balance sheet and cash flows. No scaling up will sustain itself unless it is backed by strong balance sheet and cash flows. And the third thing is you need to have a governance structure in place. It has to be company management team has to be answerable to the board. Board has to be answerable. There has to be good auditors in place. Generally, the interest needs to be aligned with the minority shareholders. So these are the things that are required for a company to be scalable. Competitive advantage. To be competitive, a company needs to have a cost leadership. Usually the source of competitive advantage is either it's a cost leadership, or it's a network effect, or it's the intellectual property that the company has created, or it is brand and distribution. Broadly, 99% of the competitive advantage that any company would have can be classified under these 5 broad things. So in a commodity industry, it would usually boil down to a cost leadership, who is the lowest cost producer. In a platform company, it usually is the network effect. Like, for example, if I am on WhatsApp, then you have to be on WhatsApp and we can communicate on WhatsApp. That is the network effect. Then intellectual property, again, some technology or some proprietary thing that you have created leads to some kind of competitive advantage you having over the others. So for example, I mean, there is a chemical company called Clean Science and Camlin. These two companies are in the same business, but Clean Science has a far superior business because they have come up with a way of developing the same products with a new technology, which is leading to much reduced costs and eventually better margins for the company. And brand and distribution. Usually the consumer companies have their competitive advantage due to brand and distribution. So for example, to give you a strength of a brand, Coca-Cola once bought the brand Thumbs Up from Parle, and they did it so that they could kill the brand because they wanted Coke to succeed in India. But guess what? They couldn't kill the brand Thumbs Up. Such was the strength of that brand. In fact, it was so strong that Coca-Cola is now actually forced to take it outside of India as well. It is gaining acceptance outside of India also. Companies have to be adaptive. See, I mean, what Darwin has said, it is not the strongest that survive. It is the companies, or rather it is even for the living beings, it is the most adaptive, flexible that survive. One has to be like a cockroach. Cockroach can survive even a nuclear blast. So ability to withstand downturns, ability to move into other areas of business, which is close by. And again, I'm not saying diversification, but you know, a solar module company getting into something like an inverter or battery is still very much in their domain, if I were to say that. So controlled experiments, the company should have the ability to do experiments which are controlled, and failure should be encouraged so that they can move on to newer things. And then, of course, sustainability in practices. These are the things that if your business model is going to be based on something which is not sustainable, eventually, sooner or later, it is either regulation or environment or governance. Something or the other is going to lead to a failure, and the company won't be able to survive. Then the long runway. Actually, when Rakesh ji used to say this was his biggest thing. I mean, company has to have a large addressable opportunity. So when I say large TAM, it is large total addressable market that the company is adapting. Then it has to be aligned demographically to the area that it is operating. It has to have favorable industry tailwinds, and there have to be multiple growth engines. If there is going to be only one growth engine, sooner or later, that growth engine is going to run its course, and we will be left with a company that has matured, in fact, prematurely ended its runway. So one needs to have a view of that this company can easily grow for the next 10-20 years. The growth rates can go up and down, but the growth is not the challenge at all. So that is large runway, long runway. And fifth is, of course, the superior execution. A company that demonstrates ability to execute is way better than a company that has a superior strategy. So Peter Drucker has a saying that execution eats strategy for breakfast. Essentially what he means is, or rather he actually says, culture eats strategy for breakfast, but the culture is what is reflected in the execution. So you have to have a great second level management. You have to have a superior cycle management. And when I say cycle, I'm talking about the business cycles. And then company has to have a superior capital allocation. So when all things are combined, you come up with a company or a potential company that is a potential candidate to scale up in a big way. And we believe investing in such scalable companies can generate long-term wealth. So that is what we try to look out for. Again, what matters in wealth creation and where we focus. This is usually, most of the business news channels or brokers or the reports that you will read will be talking about this quarter result, next quarter, what is happening. Earnings are going up and down. So what is the issue with Adani? What is the issue with RBI? What is RBI doing? What is Fed doing? All those things matter in 1 year, in less than 1 year. So changes in sentiment, changes in growth and earnings are matters from a real short-term point of view.
Recording in progress.
Hello. Yeah. While for us, what matters is actually what happens beyond the 1 year. So we focus on industry cycle, competitive positioning, the return on invested capital, sustainability of the moat or the competitive advantage that we spoke about. And eventually for a real wealth creation, from a 5 to 10 year point of view, what matters is the people and the culture, because those are the more enduring things over a longer term period. What we do not focus on is trying to time the market, trying to forecast what is going to happen, what the Fed is going to do, inflation is coming, market is going down, momentum trades. Right now, this sector is doing well. Next year, this sector will do well. What is the flavor of the season? All those things we try to avoid. Not to say that people cannot make money doing this, but it's just not what we do. So there is a 4-step research process that we have. The step 1 is to connect dots. So see, most of the people identify themselves either as value investors or growth investors. We are not value or growth investors. In fact, we strongly don't want to label ourselves as anything. We we are opportunistic investors. We will look for opportunity and we will invest. How do we identify the opportunity? A lot of people say, I'm a bottom-up investor, I'm a top-down investor. We are neither. We are neither top-down investor nor bottom-up investor. We are opportunistic investor. And again, for that, we combine the top-down and the bottom-up. So how do we do that? So let's first connect the dots. This is the top-down approach. So you first build a top-down thematic view. You go through various annual reports, you meet people on the ground, you do competitive analysis, you monitor slow changes that are happening, refocus on sectors because of things changing, with triggers panning out, corporate actions happening, management changes, or some government policy that has changed. So if I were to give you an example of, let's say, defense has always been an opportunity that will play out in India. But for a long period of time, nothing happened. It was only in the last 1 year that some big change has happened. So usually the thing is, what happens is that slow changes keep building and people don't realize what those slow changes are. And then suddenly one day something happens and the whole sector gets re-rated. It's usually because the things have been building up. And one has to have that perspective that things are moving in this direction. And these 1-2 things, if they were to happen, then actually the change will be dramatic over here. And markets usually take recognition of these things at the very last moment when actually things have already changed. So in defense, government came out with this policy of import embargo. So government tried a lot of things. First, they tried to put an offset policy. Then they tried to put a DAP policy, defense acquisition program. Still, the growth was not coming. So the government's prerogative is that they want to become self-reliant in buying defense equipment. And it is very important for India that from a geopolitical point of view, also from Forex point of view, and that our own equipment. And because we were importing so much of the equipment, if you know, most of the equipment that we have today is from Russia. And that is why even when Russia did a war with Ukraine, India had no choice but to support Russia. And also Russia is a supporter of India in UN Security Council. So anyway, coming back, you have to keep monitoring the larger picture, what is happening. That does not mean that it will give you an immediate investment opportunity. But when you keep doing it day in, day out, after a 10, 15, 20-year period, you will know how to think about a particular thing, where one particular trigger can also tell you that, this is a great investment opportunity. After we are done doing connecting the dots is when we filter out. We apply our basic hygiene filters. Is the quality of the business good? Is the quality of the management good? And again, I am not going to get into giving you hard numbers on what a quality of business or a management is. This is not a quantitative thing. It is a very touchy-feely thing. People might say 15% plus growth is good. 15% plus ROC is good. Surely some of the things can be quantified, but not everything. The quality of the business is judged more by, if you are the customer of a particular business and you know that they are overcharging you, but yet you are not able to move away from them. Let's say you own an Apple iPhone and you are a subscriber to iTunes as well. You know that it is a pain to be you're paying for it, but yet you are stuck to it. Or let's say you're going to a school and the school is overcharging you, but you have no choice but to pay those fees. So those are the kind of businesses which are actually very, very good businesses, where the customer retention, customer stickiness is very good. And the ability to extract from the customers is also very high. Then, of course, we check whether we are, whatever we are looking at the company, the opportunity is within our circle of competence. If it is something that we have not seen in the past, then either we try to quickly learn about it, but if we can't, then we'll leave out. It will not pass our circle of competence filter. Or then we look for if there are any deal breakers, look for disconfirming evidence. Most of the people after investing only look for confirming evidence, which is they keep looking for reasons why they should be holding on, especially then when the stock price goes down and is like 30, 40, 50% down, then they are not able to sell and they only look for evidence which says no, things are not bad, things are not bad. You should always look for disconfirming evidence. What I mean is, let's say your hypothesis is that this company is great because they're able to command a higher pricing because of this technology. But as you keep talking to people in the market, and when I say market, I'm talking about the company's market, you realize that no, there is a competing product available. It has a superior product. It is a superior technology and it is available at a cheaper price. Then you need to stop fooling yourself that, okay, this is a great company. You know that there is a substitute available and this there is a disconfirming evidence to it and your thesis is wrong. You should exit out of it. Then you look for competitive advantage and unique positioning of the company. So after connecting the dots, you filter down based on these, and then you go down and then you start investigating deeper and deeper. You do desk research for historical perspective, how the company has managed its balance sheet, how did they, was their capital allocation good? Has the management action been always minority shareholder friendly? You go and check out with the various other stakeholders, whether it is the competitors, vendors, auditors, whoever you can find, a domain expert who will tell you that, this company is doing this right, this company is doing that right. See, nobody has a complete perspective, but a lot of people have a good insight into a particular thing of a company. So if you can get that kind of an insight, it will add a lot to your research. So you should do a 360-degree scuttlebutt, as it is called. Then you try and connect the narratives to numbers. Nobody explains this better than Professor Ashwath Damodaran, and I would highly recommend that you guys see the videos of Professor Ashwath Damodaran on valuations. But essentially what happens is, usually there are people, those who tell you what is the story of this company. This company is doing this and it will do this, and in 5 years this will happen. Great. That is a starting point. That is the narrative. That is the story. Then you try and connect it to the numbers. Is it really possible that can they achieve this kind of numbers in 5 years? Has it happened? There is something as Professor Sanjay Bakshi explains, is the Bayes theorem, which essentially says you have to understand the Bayes rate of whether that particular hypothesis is going to pan out or not. If it is something very outlandish and outrageous, then it probably is. So there has to be a connect between the story and the numbers. And then last but not the least, when you are investigating, you always invert. This is a quote by Charlie Munger. What does it mean? Invert, always invert. It essentially means you turn your hypothesis on its head. Let's say your hypothesis is that this company is going to go from being 5% market share to 10% market share, and it is going to improve its margins from 5% to 8%. And if that happens, then you will make XYZ kind of money. You need to constantly question, why will it go from market share 5% to 7%? Why will the margins improve? If you should constantly keep asking the premises of the hypothesis that you have built. And then last but then not the least is risk reward. Anything that you buy has to go through the prism of, you might have discovered a great company, but what is the point of a great company if it is already very, very overvalued? Then you're not going to make any money on it. So then you try to see, again, valuation is an art. Valuation is not a very, very number focused thing. A lot of people try to say the EPS is going to be this in FY25, and then we will give it a 30 multiple, and that is why this is the value of the company. That is a rubbish way of valuing a company. Those are shorthands. See, those are derived numbers. What you need to understand is, and you have to always look at the whole of the company and not a share or a share price. The question that you have to ask yourself, and I'll just explain with an example is, let's say a lot of people say these new age businesses are overvalued or they are crazy. What is the rationale of a 100p or a 200p? Company like Nykaa, the question you have to ask is this company worth 40,000 crores? Assuming that is the valuation today of this company. Why would this company be 40,000 crores? Then you go back to, it is addressing a market size of 1 lakh crore. It has 7% market share. That 7% market share is going to go to 25% market share. They are entering into new adjacencies. From beauty and personal care, they are entering into fashion, and they are also building a back-end logistics business around it, blah, blah, blah. All those things are why, in my opinion, this company should be worth 30,000 crores or 40,000 crores. If that is what you come up with, that will tell you that, okay, you are in the ballpark. Or see, it is better to be approximately right than to be absolutely wrong. So don't go by exact numbers whether that valuation is right or wrong. If in your opinion Nykaa is undervalued at 35,000 crores, then it doesn't matter if the price on the screen is 40,000 crores. See, market can swing and market can end up undervaluing the company even more than what it is. But if you strongly believe that it is undervalued, then you should not try to time the exact bottom. You should always focus on, it is undervalued and I would like to buy it. It's a great business and I would like to buy it. Then you see, what is the market thinking? Is your perception different than what market says? Is the margin of safety, capital loss probability there in the business? Is it carrying too much business? Can the business go bust? Is there a possibility of making a risk reward, which is like always take bets which are like 1:3 payoff minimum? When I say 1:3 payoff, that the risk, if you're wrong, is you probably lose 50% of the capital. But if you're right, you make 3x. You need minimum that kind of a risk reward for you to be justifying placing a bet. Everyone comes up with their own risk reward, but this is broadly what I'm saying. I would like to place a bet where if I'm wrong, I would double my money, and if I'm right, I would go 10x my money. But if you have to find those kind of bets, and then how much of the narrative is captured in the numbers. So these are the 4-step research process that we employ in identifying opportunities. So that takes care of the 2 sections of the presentation. Now comes the real presentation that I am talking about. Till now, we were only discussing about ValueQuest and ValueQuest framework. Now, this is a presentation. Investing is simple, but not easy. I know simple and easy sound the same. In fact, we use it almost interchangeably. Sometimes people say, this is so easy and simple. Or this is it is basically very confusing term for a lot of people. If it is simple, then it has to be easy. But I'll tell you, simple is the opposite of simple is not opposite of simple is complex, and opposite of easy is difficult. So that is what we are talking about. So investing is simple in the sense there is not much complexity. In fact, the more complex you make it, the worse it is for you. But following those simple things is not easy. Let's take a look at what I am talking about. So this quote is obviously by the great man himself, Warren Buffett. Investing is simple but not easy. But what does it mean? So what is a simple investment philosophy? Everybody has some version of the same investment philosophy. You buy good companies, good management at a good price, and the result you will have is a good investment. Of course, it is easy, right? What is good company, good management, good price? Let's take a look at what are the questions that we have to answer. What is a good business? What is good management? What is good price? And how long do I sit tight? The investment philosophy that we are talking about, the consequently is buy right and hold tight. So and sit tight, is it? So, but even sitting tight or holding tight and how long to hold tight, these are questions that we have to ask ourselves. Let's see what is the practical difficulty in all these simple investment philosophy. So all of you know HUL. Is it a good business? Of course, it's a good business. It's a fantastic FMCG company with so many brands, so many deepest penetration in India, and fantastic ROC, return on invested capital is great. There is absolutely nothing in corporate governance terms, it is great. But can you imagine even a company like Hindustan Unilever gives 0 returns for a period of 10 years from 1999 from 2000 to 2010, 11. So good business is not necessarily a good investment. Is Reliance a good company? Of course, we know it's a fantastic execution company and they invest with a very, very long-term horizon. But even a company like Reliance, post 2008, did not give any returns for a period of 10 years. From 2008 to 18 was almost zero return in a company like Reliance. So good company does not make good investment. Nestle is the company that makes Maggie. So now we are moving to the next question, which is good price. So, you know, Nestle was a good company, but was it ever available at a good price? In this chart, if you take a look, let me just put a laser pointer. So this is actually the P multiple. If you see, the P multiple has never fallen below 20 for Nestle, and it has gone as high as 120, and even now it is at 70, 80. Now, people say 20 was a very attractive P multiple, but you know, at that time, the whole of market was available at a less than 10 PE, and you would have easily found so many good businesses at a 4, 5 PE multiple. And when that is going on, and then Nestle is available at a 20 PE, you see that relatively it has always been very expensive. So not necessary that you will ever, low PE multiple is not a good price. You have to understand it in context of the quality of the company, and you have to foresee what is going to happen over a long period of time. That this company is going to dominate the food category, the snacking category. It is going to move into different categories like maybe dairy products, and that is where you will realize that the future value of this company is much higher. How can you possibly do that? Take a look at what is in the portfolio of the parent company. Take a look at what is the kind of valuation that these companies are getting overseas. So for us in India, it is actually a much easier job because this value creation thing has already happened somewhere in the world. So you can actually just pull out the numbers and see what is happening. And India being a growth market, a lot of times you can actually see that the companies get better valuation in India as compared to the world. Amazon is a fantastic company, right? It is like the first company to reach $1 trillion. But can you imagine in 98, 99, when the dot-com boom was going on, post dot-com boom, when the bust happened, this company collapsed by 95, 97%. Do you think it is possible for you to hold on to a company where you put your life savings and you see 97% kind of drawdown? Even after that, there have been numerous occasions of 30, 40, 50% kind of drawdown. How do you hold the company through them? So we are actually now moving to the third aspect. See, we talked about good business not being good investment. We talked about good businesses not being available at a good price. And the third is, even if you have good price and good business, but holding on to it is even more difficult because there is so much of price fluctuation that happens. Then let's come to some of the fundamental. You know, everybody says you should always buy a growth company. Now, would you buy a business where the volume has been declining for last 2 decades? If I were to tell you that this company has been the best wealth generator of the last century, but in the last 20 years, the volumes have been falling. This is a company called Altria. Altria is owned by Philip Morris. Philip Morris is one of the largest cigarette company in the world. Since 1997 till 2019, the volume of the cigarette has constantly kept falling, but that has not prevented the stock of Philip Morris from being the best wealth generator. This is Coca-Cola, same thing. Look at the growth, 4%, 3%, 2%. For a 8-9 year period, the growth is barely 1-2%. And yet it is one of the largest holding for Warren Buffett, and it has been a large wealth creator as well. So what you realize it is not only the volume growth. What you have to look at is the revenue growth, and more important than revenue growth is the profit growth. More important than the profit growth is cash profit growth. And more important than the cash profit growth is the ability to reinvest those cash profits to generate ROCs. That is what leads to a creation of wealth. So you can see that this orange line is essentially the growth in the volumes, while the blue line is the stock price. How the stock price has kept on going up even despite the fact that the volumes have not done very well. Coming back to the valuation, okay, if we could not buy Nestle, which is a good company at it was never available at a good price, but at least these companies are good. These companies were available at a good price, and you could have always bought at a good price. Yes Bank, Satyam, DHFL, they were always valued lower than rest of the market. Yes Bank was always cheaper than any other bank, HDFC Bank, ICICI Bank. Satyam was always cheaper than Infosys and TCS. DHFL was always cheaper than some of the other financial firms listed in India. But that tells you that market is actually telling you if it is something is available cheaper, you need to dig deeper and understand why it is cheaper. You will find out that there is a very good reason why some of these companies are trading cheap. And you might not want to buy it just because it is cheap. So again, we come back to the same simple investment philosophy. Good company, good price, good valuation will be great investment. But finding a combination of a company which is all three is very, very difficult. And when you do find something like that, you should back up the truck and load onto it. You should buy as much as possible. So as I just now mentioned, good business is not equal to great investment. Good management is not equal to great investment. And good price is not equal to great investment. You need all three. You need good business, good management, and a good price. And that's when you make a great investment. So I'm going to take you through the example of Titan. Everybody knows that Rakesh ji made the money of his life in Titan, where he still continues to hold close to 7-8% of the company. I mean, of course, he is no more with us, but his family still continues to own 7-8%. But the journey, have you ever imagined what the journey of having that kind of a wealth creation is? So when you look at this chart, it's the longer term chart. It looks so easy, like you should have bought over here in 2002-3 and held on to it till now. But I'll tell you, I'll just blow up some of these price movements and show what happened. So Titan has had more than 12 drawdowns, and this is only till 2019. If I were to add 21, 22, 22, 23, I'm sure there is a price decline even that time as well. And I'm only talking about the price decline which are more than 25% over here. I'm not even talking about a 10%, 15% price decline. Okay, 12 price declines of more than 25%, 2 price declines of more than 50%, 1 price decline of 82%. Do you think you will be able to hold on to this company for a period of 20 years if this kind of price fluctuation was there? So what I will tell you, if you are not going to build the conviction to hold a company for 20 years, you might as well not buy it. You're not an investor in the true sense. So this is the 2008 to 9 fall. Over here in a span of 1 month, the stock would have fallen by 70-80%. And then again, after rising, it continued falling for another 12 months or so. Then post 2008-9, there was a 10 to 13 fall. Again, this was like a 30-40% kind of a decline. Then in 18-19, again, it fell very, very sharply. So there have been so many instances of sharp fall in a company like Titan, which we all know is from the group of Tatas, is into jewelry business. There's a large business opportunity, but yet because the numbers were so up and down, the price fluctuation was very wild, and that would make a lot of people lose their conviction and patience. So it is one thing to tell that, okay, just buy a Titan and hold on. But it is another thing to actually do it. So did Titan make RJ? So, a lot of people say that Rakesh Jhunjhunwala was lucky. He got Titan and he just held on to it, and that's how he made his money. So that's so easy. Sorry, my bad. That is so simple. but it is not easy. So everyone had the same opportunity, but not many could identify. Even fewer could build a substantial position, and only one could hold through ups and downs. So that is why it is not easy to be Rakesh Jhunjhunwala. You have to have the wisdom to see that this is a great company. You have to have the fortitude to hold through the ups and downs, and you have to have the courage to capitalize. You have to buy big and you have to hold on, and that is when you make large wealth. Now, in general, how to hold through, like it's so simple, right? Investing philosophy: buy right and sit tight. But will you be able to sit tight when market falls 27%, 22% on a closing basis in one day, and on intraday basis it was down almost 27, 28%, if I'm not wrong. This is in 1987. Okay, US market fell 27 one day, and more than 1/4 of the wealth was eroded. Or through 9/11, where you thought, okay, terrorists are attacking. If terrorists have reached US, which is like the strongest country in the world, how are we going to survive this? There is going to be war. There is going to be everything. All hell is going to break through. Markets were closed for a period of 15 days after this, because this was so close to the financial markets. And everything opened limit down in India also. Imagine holding through that. Or when we were going through a global financial crisis, when one after the another dominoes were falling, companies were going bankrupt. Forget companies, even countries were going bankrupt. In that kind of a scenario, do you think you will be able to hold on to your investment? Or now the latest one that we saw, which is the COVID, where actually the life was put on hold. We actually manufactured a recession ourselves. It was a complete shutdown of the economy as we know it, and it was across the world, and we had never seen anything like this in 100 years, and we had no idea how to react to it. It's like people are not allowed to move. This is something that will be fresh in everybody's mind, because all of us have lived through it, but not being allowed to go venture out, how is that even possible? And again, now maybe we are 1 year out of the COVID emergency, but if now somebody was to say that, you'll have to go into lockdown again, I don't think we have the ability to survive that. So, but through all this, how do you hold on to your investment is the most important thing. So it is simple to say, just hold on to your good investment, but it is very difficult to hold on to it. This is Jeffrey Luriston Livermore. Essentially, there's a book called Reminiscences of a Stock Operator, which I highly recommend to anybody who comes to the market. It reads like a storybook. It is essentially letters of a person that were published in New York Times. It is an account of a person who was a stock operator. They were called stock operator in those days. I'm talking about more than 100 years back. So his learnings are very, very useful even today. This is a quote from him. Men who can be both right and sit tight are uncommon. I found it one of the hardest things to learn, but it is only after a stock operator has firmly grasped this that he can make big money. You all have aspirations to make big money in the market, but if you really want to make big money in the market, you need to first have the ability to withstand the kind of volatility that market is going to throw at you. And trust me, it is going to test you. No amount of warning or no amount of reading about it in the past is going to prepare you for what lies. When your actual money is at stake is when you come to know how you're going to behave. Greed and fear. Again, another simple concept, right? Buy when everybody is fearful and sell when everybody is greedy. But is it that easy when everybody around you is greedy and everybody around you is making money, and you see your neighbor making money, your friends making money, your gym trainer making money, and everybody is telling you buy Adani, it is so easy to make money, you buy and next day it goes up, it makes you feel like you are foolish. Buy stock options, buy options, it is so easy. You buy 10,000 rupees, you make 1 lakh rupees. I made 1 lakh rupees yesterday. But everybody gets carried away. Nobody is able to withstand the lure of what is the collective greediness that comes over all of us, or even collective fearfulness. And fear is actually a stronger emotion than greed. You will be able to resist greed for a long period of time, but you will not be able to resist fear. When people start telling you, oh, you know what, the world is coming to an end, or there is going to be a nuclear war, America is going to default, India is going to go the Sri Lanka way, this is going to happen, that is going to happen, world is going to shut down. Very difficult for you to think rationally, to say it does not matter. The money that I've invested is, I don't need it. I'm going to stay invested. It is my investment money. I have bought good quality companies. I will see on the other side. If it is a nuclear war, it doesn't matter. All of us will be dead anyway. So, but if we survive, I might see the value of my company go up over a 5-year, 10-year period. So yeah, being having conviction and courage when everybody around you is panicking is something that will make you stand apart. So all of us go through this cycle of emotions, and I'm just gonna, I mean, it's not that none of you have seen this, but it's the cycle of optimism getting excitement, then excitement gets thrilling, and then we reach a stage of euphoria. Okay, this is the stage at which you don't need too much brain to make money. In fact, if you have brain, then you are at a you have a problem, because you will be thinking rationally. And while people, those who have no business being in the market or no business making money, are making money hand over fist. This is that phase in the market. Currently, we are not in that phase. We will probably selectively in particular stocks were in those phases sometime back. This is the point of maximum optimism. Then this thing starts unraveling. First, there is anxiety. And we are like, oh no, stock has gone up. But every time previously it had gone up, gone down, it would start going back up again. So you convince yourself, no problem, it will come back up. You are in denial. Then from denial, you go into fear. Oh no, I bought it at 100, saw it go to 200. Now it is back down to 150. So fear has started catching up. But I'm still in profit, so I'm going to hold on. Then you start getting desperate. I bought at 100, it went to 200, now it is back to 125. I was making so much money, now I can't sell. Now there is hardly any profit. And in that, the stock comes below 100, the price at which you had bought. All your gains are gone, and now you're totally frozen. You are in panic mode. And then when it goes and hits 70 rupees, you are in 30 rupees loss, and that is when you go and start capitulating. You sold, and then you realize that from 70, it went to 50 rupees. So you are happy that you sold out. I knew it was going to go down. That is the point of maximum pessimism. And then things start reversing. Okay, there is a depression, but there is a lot of value in the stock. Some hope comes back. There is relief, price goes back up. But then whoever had not sold earlier are the ones who come and sell. And then actually it is the time to be optimistic. So we all go through this cycle of emotion. So Mr. Rothschild made a very good statement. It is buy when there's blood in the streets, even if the blood is your own. In fact, some of the blood will be your own if you are in the market. But it is very difficult to do that. When whatever you are holding is already losing 50% money, and then somebody tells you, this is the time to buy, you don't think rationally. You are only thinking about, oh, I'm losing so much money here. You're not thinking about the opportunity that is present. So time in the market versus timing the market. If you were to invest and stay invested throughout from 1991 to 2011, your 10,000 rupees would have become 57,000 rupees. But if you miss the 10 best days, your returns would be more than half, or at least half. If you miss the 20 best days, then you will be 18,000. So the point being, if you miss the 50 best days out of the 20-year cycle I'm talking about, 20-year means how many days? That will be 3650, around 7,500 days. Out of that, you missed 50 days and your returns are negative. You are down to 50%. So to be able to make almost 6x your money over a 20-year period, you miss out on 50 best days, you are negative 50%. What that tells you is that you should not try to time the market. You should stay invested. Eventually, market will take care of itself. This is another study that was done by Bank of America, which tells you that if you had missed out on the 10 best days in the from 1930s to 2010, then your return would be plus 91%. But if you had stayed invested, then you would have made 15,000% return. The same philosophy applies everywhere. Okay, everybody knows compounding is the eighth wonder of the world. But this is a demonstration of the Warren Buffett's wealth. You see how his wealth has grown. He had, when he was 14 years old, he had $5,000. He made his first $1 million when he was 45 years old. He made his first billion when he was probably closer to 65 or so. And today, in fact, this is not the updated one. The updated one by the age of 94, 95 is probably worth 120, $30 billion. That is the kind of compounding that can happen, but you have to stay invested. Okay, I have said a lot of good things about Warren Buffett, but there is one bad thing also, or maybe not bad, but it is not easy to live up to your own words sometimes. Our favorite holding period is forever. Okay, but if you go and check, even Warren Buffett is not able to hold on forever, or he makes mistakes, and even he has to sometimes sell things from time to time. So during COVID, he actually exited all his airline stocks. Okay, so even Warren Buffett thought that it was not a great time to be holding on to airlines, and it turned out to be a wrong decision. First, he went back on his own thing that he favorite holding period is forever, and second, his selling was not the right decision, because after that, actually the airline stocks have done very well. So investing requires qualities of temperament way more than it requires of qualities of intellect. So there are a lot of smart people in this market, but the smartest people are not the ones that make the most money in the market. In fact, smartest people get frustrated when they see that less smart people are making money, because the most important organ in the stock market is not your brain, it is your stomach, and not people will tell you. And that stomach comes into play when you have to hold on to your good investment in a very tough period. That is exactly when your stomach that is why if you do more crunches and you're doing abs, you will be a good investor. Sorry, that was a bad pun. It is not the actual physical strength of your stomach that I'm talking about, but it is the ability to withstand volatility and risk is what I'm talking about. Again, these are all biases. I know this slide is too busy and very difficult for you to see, but these are all various types of biases. Your biggest enemy is yourself. Being an investor, you have to, fight yourself more than anything else. You bought that, the moment you bought something or sold something, your mind starts playing with you. If you sold something and the price goes up, you start questioning yourself. If you bought something and price goes down, you start questioning yourself. There is a bias in everything that you do. If you have bought something at 100, you sold something at the same thing at 200, you are very happy. Next day, that 200 goes to 220. Will you be able to buy it? I don't think anybody. There are very few people who can buy something at 220 after selling something at 200. Their ability to overcome these biases will determine how successful an investor you become. It is all good to talk about vision and courage and ability to make money, but even the smartest people sometimes make money out of sheer luck. So there is a story that Ramdev Agarwal says that he had bought Eicher Motors because the CV story, the commercial vehicle story, it was going to do very well. But the stock did brilliantly because of Royal Enfield, the bullet motorbike as we know it. And nobody had any idea that it is the bullet that is going to make the money. Rakesh ji bought Titan for the watches. At that point of time, it was a watch company and it was a turnaround story. But the real wealth was created because of Tanishq, which is the jewelry part of it. But in both these stories, maybe their identification of the stock was luck, but their ability to hold on to the investment definitely required skill. And this is one third one, I'm sure you don't know about it, but I'm going to say it is the biggest investment ever made by any person on this planet. Would you have invested $20 million in 1999, which is 1 year before .com crash? Okay, almost 90% of the companies died at that time. Other 10% that survived also had a gut-wrenching 90-95% kind of fall. In a completely unknown startup with no business plan, zero revenues, and 35-40 employees at best. This is the greatest investment ever made by Masayoshi Son into Jack Ma or Alibaba. Okay, it went on to become almost $100 billion kind of returns, if I'm not mistaken. Okay, don't hold me on that exactly, but it is the best investment ever made. But that was sheer skill, in my opinion. It is not a skill that can be replicated. Then there are some rookie mistakes that a lot of people make. People come to the equities market expecting 15% return. Yes, market will give 15% return, but it doesn't happen every year. In fact, there is not a single year in which market has given 15% return. It will either give plus 30%, minus 20%, plus 80%, minus 50%, which eventually leads to a 15% compounding over a long period of time. So if you expect every year 15% return, you are going to be disappointed thoroughly. Then there are a lot of people make good money in housing. It is not because housing is a better asset class, but it is because there is no choice. Once you have bought a house, you are most likely going to hold it on for 10, 15, 20 years. And it is the holding that makes you money. If you were to do the same thing with the stocks also, I guarantee you your returns will be better. But you have to have that patience and the convictions and ability to withstand the volatility. The mental agony of seeing prices daily and sometimes down 30, 40, 50% is what makes people panic and get out of. As Peter Lynch says, the trick to making money in stock price is not to get scared out of them, while the market's job is to keep scaring you on a daily basis. This is a green line, which is Berkshire Hathaway. If you can see, even Berkshire Hathaway for a period of 10 years has underperformed. So underperformance is nothing. It's okay. Everybody performs and underperforms. But if your fundamentals are right, if you have picked the right company over a long-term period, you will make money. It is the wanting to make money in a short period is where the problem lies. Be long-term greedy is what Warren Buffett says. With that, I know I have overshot my presentation by almost half an hour. It was supposed to be a 30-minute presentation, but I have shot all the way till 1 hour. But that's where my presentation ends. I hope you found it useful. I'm happy to take questions.
So it was simply amazing. I actually have a lot of questions on chat, but quite a lot of them overlap with already existing submitted ones. So shall I share screen for the questions which the candidates had shared with us after reading your blog?
I can pick and choose.
Right, perfect.
I'll stop sharing my screen.
So these are the list of questions which we had, shortlisted at our end. None of these questions are company specific, obviously, something which we respect. What we have done is, if you'd allow, I'd like to moderate on behalf of the candidates.
Sure.
We have clubbed multiple questions together, which were themed on the same lines. In fact, some of the questions which were asked through the course of the sessions, I'll try to club it along with these questions to, incorporate those queries as well.
Perfect. That would be great.
Perfect. So shall I get started?
Yeah.
So the first question is basically around judging industries. Like you talked about, the scale investment ideology which you guys follow. In scale, you actually talked about, the distribution channels and how it goes about, identifying that particular strength of that particular industry, competitive advantage as such. Now, the question which we had was, we read your blog on AMCs and you talked about that it as an industry, it is, underpenetrated at the moment. Businesses have really good balance sheets. At the same time, when it comes to the financial revolution, which is happening in India, the amount of money which is being pumped into these companies to manage money is increasing with every passing day. However, the market seems to be getting a bit nervous around these AMC businesses. The valuations seem to be, taking a hit, or at least the market capitalizations of the companies seem to be taking a hit recently. Now, in such situations, how do you go about judging these industries when even the large players are actually reporting average or below average results and the valuations are coming down?
So one thing you have to understand, AMC is a fantastic business. Okay, I myself am in this business. I manage funds. The problem with this industry is that the yields are declining. Okay, people keep asking for lesser and lesser fees, and that is the challenge with this business. And the second challenge with this business is there is a digitization that is waiting to happen. A lot of this industry is dependent on distribution. And when distributor takes away 50% of a manufacturer's margin, that tells you that this industry is ripe for disruption. So these are the two challenges facing the industry. But if you are to ask me, a brand, great product, great brand, great distribution is going to lead to a winner in AMC. I think currently the short-term worries about yields falling and disruption are suppressing the valuations a lot over here. But the runway is large. You have to just see what has happened in US. Okay, US may Vanguard or BlackRock, they manage $5 trillion, $6 trillion. The biggest AMC company out of India will be less than $30 billion. So that is nothing as compared to what has happened in US. So that's a huge runway that is ahead of us. Now, one is that. Second, we are witnessing the financialization of the economy in front of our eyes. Not only financialization, but also the unorganized to organized shift is happening. So eventually all this money will have to be managed by somebody. See, either you do it on your own. Broadly, if you see, money will either, some of it will be managed by the fund manager, some of it will be managed by people themselves. The people who will manage themselves will always be a very small number. Not everybody is going to get into the business of managing their own money because that is not their day job. Their day job is to doing some other business or doing a job somewhere. So that is why you will always need fund managers. And if there is a fund manager, somebody who has established reputation, good brand and distribution, and a track record, then eventually those players will get flows, because India is finally a savings economy. We are at $3 trillion, $3.5 trillion. We save about 20-25% of that, which is roughly about $600 to $700 billion. Out of that $600 billion, $700 billion, only about $20-30 billion goes every year into equity products. That percentage can go, even if it was 10%, would be a 3x the amount. So $60-70 billion kind of annual cash flows we can get, which go into equity products. So I have absolutely no doubt that this is a fantastic industry. The yields will keep falling, but at some point of time, valuations would have factored in, and they will become great investments also. Right now, I'm saying it's a great industry, but investment opportunity, it is coming. It is almost there, in my opinion.
Got it, sir. Thanks so much for that answer. It really helps. So moving to the next question, some great investors have already talked about that we should take a look at market cycles as well as stock cycles simultaneously, and not just take a look at one particular aspect. So, in terms of this understanding, what do you go about, thinking? So, for example, what we have here is, a couple of years back, we saw there was a crazy market cycle, and quality stock cycle was super strong. However, in last 1.5 years, almost, the market cycle seems to be weak, as well as the quality stocks seem to have taken a severe beating at times as well. Whereas when it comes to, let's say, capital goods cycle, we have seen a crazy good amount of sort of cycle, super cycle when it comes to this. So how do you go about taking a look at a stock cycle or a market cycle simultaneously? And what's your take on these?
So usually when you look at the macros, when you look at the markets, essentially what you're trying to do is judge what kind of investment conditions exist. So I would equate it, if I were to give you an analogy, and I think Morgan Housel has made that analogy, but you cannot predict what the daily weather is going to be, but you can predict what season we are in. We are in winter right now. In winter, it is cold. Winter will be followed by summer, and summer will be followed by monsoon, or some or the other, whatever the sequence of the events are. But it is easier to predict seasons than to predict daily weather. So you should focus on that. If market is being very optimistic at that point of time, you should have a slightly defensive approach in investment. It does not mean that you sell out everything and go away. No, that is an extreme reaction. But you might want to not buy into companies where there is too much dependence on what the future holds, or there is too much valuation being given to the future growth. So use the market cycle to determine whether there is an opportunity there or not there. So for example, Warren Buffett says that buy only a business that you would be happy if the market was to shut down for 5 years. There is another saying which says that stock market is a giant distraction to the business of investing. So essentially, stock markets, you should look at it only to give you two answers. Is this a good time to invest, or is it a bad time to invest? And good time to bad time is also not an absolute. There might be bad times to invest when you might still find a good opportunity to invest one particular company or one particular sector. Or there might be good time to invest, but you might still end up making a wrong choice of investment. So think of, you have to have a broader perspective of where we are going, and you have to then drill it down to the investment. But when you're making that investment, you're investing only if you're investing in a particular company with a 5-year perspective. You have to understand that there will be a cycle in that. There will be a stock cycle, there will be a market cycle. I have to live through both, and yet I have to make money in over a 5-year period. I hope that answers your question.
Yes, sir, definitely does. Thank you so much, sir. So moving to the next question. The next question is more on the lines of, there are particular industries which are heavily influenced because of government decision makings and reforms. So how do you go about, incorporating those aspects as a weightage in your investment philosophy?
So yes, you are right. At this juncture, actually, a lot of businesses which are doing well are heavily influenced by government policy. Because what you need to be aware of is, even if the business is influenced by government policy, you have to have an outlook on policy as well, on the government itself. Okay, and you have to at least have the cognizant of the fact that this particular investment is dependent on government policy. In your entire portfolio, you might not want to own more than 2-3 such stocks. I'm assuming you have 10 stocks. If you have 10 stocks, don't allocate more than 20-30% to companies that are very, very much dependent on government policies, because those things do change. Government can change, policies can change. But if you have invested when the things are in your favor in terms of valuation, when the policy is in your favor, you will still make good returns, and you still get to see, even if things dramatically change overnight, you will get an opportunity to exit at a good price.
Got it, sir. Thank you so much, sir. So the next question is, you were one of those investors, very few investors, who correctly predicted the rise in API and pharma stocks during COVID. What framework exactly? I mean, we understand the broad level factors which you walked us through. Like, any particular framework which you use while understanding this aspect, and especially the major part of it, which is, when do you exit?
So you know what, I would like to correct you over there, Shailesh. I saw the first part clearly, that pharma companies are going to benefit, but I did not see the second part very clearly, which is that opportunity was a very short-lived opportunity, and in fact it crashed. But lucky for me that I got out of a lot of it soon enough. So when the COVID was happening, we classified things into the framework that you're talking about. Is one, what is going to be a lasting impact, something that is going to last for 5, 10, 15 years. what is going to be a temporary impact, something that might last 6 months to 2 years, and 3, what will be something that is in fact going to change for the worse, as in it was being done till now and will not be done ever. Or so, for example, travel was one thing which was a temporary negative impact. Work from home was a temporary positive impact, but some aspect of the work from home is a continuing thing. IT companies have shifted to, some of the companies have adopted it, giving flexible working hours or flexible timing, and still continuing even though the COVID is not there anymore, because it helps them reduce cost. So one had to figure out where do you place these opportunities. So pharma and API, we clearly saw that there was vaccines, drugs, everything. In fact, the entire portfolio of a lot of pharma companies shifted from zero COVID products to almost 40-50% of COVID products. That is the kind of growth they saw, and everything else just fell. So, but the COVID went out as quickly as it came. It was, if you see Rakesh's interview, you will see that he was very clear and vocal about it, that this is flu, this is not cancer. We will find a cure for it. The death rate was actually on the lower side. I mean, I'm not taking away from the tragedy of losing life. If one has lost a personal, somebody in the close area, it is always tough. But when you look at it at a human tragedy level, it was okay. People with comorbidities were the ones who were vulnerable, and it was not a threat to the humanity at large, so to say. So we would have eventually overcome this thing. So I mean, that's how we were looking at it. But the bunched up opportunity didn't last very long.
Sir, you're on mute.
Yeah, please go ahead.
Sir, not able to hear you. I think once again it got on mute.
No, I'm putting myself on mute because there is some noise over here. But please go ahead and ask the next question.
All right, sir. Thank you so much, sir. Sir, you said you basically segregated it into different time frames in terms of how long-lived, short-lived, or how exactly you went about going that. Like, obviously, you had to keep a real-time check of the opportunities during the time frame, correct?
No, clearly it was a matrix. One size was the time frame, other side opportunity.
Sir, sorry, you are not audible.
Can you hear me?
Yes, sir, much better now.
Yeah, so I said clearly it was a 2x2 matrix. One size was the size of the opportunity, other side was the time frame that it is going to last. What happened is, and as you rightly said, we have to constantly keep monitoring. What we realized is that a lot of the trends that we were at that point of time thinking will last slightly longer actually turned out to be did not last too long. So travel came back with a vengeance. The drug habits changed dramatically as soon as the COVID was gone. So it had to be, we had not lived through something like this for 100 years. So there was no real compass available, and you had to monitor it on a real-time basis to see if things are panning out the way you thought they are panning out.
Got it, sir. Thank you so much, sir. So the next question is, in one of your latest interviews, you mentioned that you have detected shifts happening on manufacturing teams in India. Any particular parameters which you are tracking to to understand this theme in much better? And as you rightly mentioned, in terms of opportunity, how long it might actually plateaued out, or probably a long-term trajectory which you see.
So I believe manufacturing in India is a real long-term trend. It's a renaissance that is going to last for at least a decade, if not multi-decade. And the reason why I'm saying this is that India as a country has never focused on manufacturing. We have always disincentivized size scale. We have seen China grow the way it grew right in front of our eyes in the last 3 decades, and we did nothing about it. We were never competitive. Now, today, the stars are aligned. There are push factors, there are pull factors. The push factors are the government giving incentive to companies to achieve scale. Earlier, government used to give 100 rupees to 100 companies, and those incentives were based on not based on size. Today, that 100 rupees is being given only to the top 5 or 10 companies, and it is based on them achieving certain size and scale and being able to compete with the world. So that is a push factor from the Indian government side, where they are incentivizing scale. They are giving you some amount of protection from other countries by imposing anti-dumping duty. And then there are pull factors like China plus one, where China has become a middle income country, where it is $5,000, $7,000 kind of per capita. And once that happens, what happens is people don't want to work in the factory as a labor anymore. The blue collar jobs naturally go away. People want to work in white collar jobs. So, and China used to follow a one-child policy. Because of this one-child policy, suddenly the working age population in China has fallen off the cliff. So now there are fewer people available, and out of those fewer people, fewer want to work in factories. So the costs have started going up. The biggest reason why the manufacturing shifted to China was because China used to manufacture everything at 1/10 the cost of whatever the Western world used to make. And that was because there was cheap labor, cheap government, and cheap energy cost and capital. Now all those things one by one are receding. The capital is not cheap anymore. The people are not available, and as they are available, they are not cheap anymore. And their customers have realized that they have become too dependent on China, and they want to move away from China. So they are looking for an alternative, and India is the only alternative which has such a large market, which has such a large manufacturing base, which has so to say, the electricity is available. Land cost is on the higher side in India. So the two problems that I see for this manufacturing theme is that Indian judiciary is very clogged. It takes a lot of time for these cases to resolve themselves. And the second is India is still not part of a major trading bloc where free trade agreement, so the free flow of trade can start. Those are the two small stumbling blocks which I believe will be taken care of in the next 2-3 years. Once that happens, then the India's creativity will be unleashed, and the manufacturing renaissance will be really. So we will go from being 15% of the GDP in terms of manufacturing to about 25-30% of the GDP, and I think that is going to happen over a period of somewhere between 10 and 20 years. So I believe it's a long opportunity, really long opportunity.
Thank you so much, sir. That actually answered more than what I had asked. I think it covered everything, which answers basically everything. Thanks so much for that. So the next question is more on the lines of execution. So you mentioned in your presentation, and this is something which a lot of students also asked on chat, that you mentioned that you take a look at management execution. Now, obviously, that is something which you have visibility once the output has come across. Now, recently, what we have seen is, some of the good managements of businesses, they seem to have turned out to be far too optimistic on their projections, and then they are revising their projections, not because of a bad management, but also sometimes maybe because of a lot of bad quarters as well. Now, how do you go about judging whether the good management has actually given intentionally an over-optimistic estimate, or they are being too overconfident about it, or it's actually a rational and something which you see the firm executing it the way it is right now?
So you know what, a lot of people, and it was implied in your question as well, tend to judge the management by the P&L. I don't judge the management by the P&L. I judge them by the balance sheet. And you are absolutely right. So, in good times, management tend to get carried away and give wild projections, and then try to justify whenever they don't meet. But what you have to look at is through the when you look at the last 20 years balance sheet, you will realize in the previous cycles how had they acted. In the up cycle, were they aggressive, conservative? In the down cycle, were they aggressive, conservative? In the what was the peak margins they made? What was the bottom margin they made? Did they leverage themselves? What were the kind of cash flows that they made? you will be able to judge a company's management through its balance sheet and not through P&L. P&L is at the mercy of the industry cycle that it is in, but the balance sheet is in the hands of the company, and that is the execution that we need to judge. How well they manage their cash flows, and did they use their balance sheet judiciously, cash judiciously or no? Did they end up over leveraging? That is what, those are the things that tell you a lot about the execution of a business. And a management that has lived through such multiple ups and downs will never guide you over optimistically. They know that the current times are good. The good times also don't last forever, and the bad times also don't last forever. A business that is telling you in bad times, a company that is telling you in bad times that things are going to improve but slowly, is a good management. And in company that is trying to temper your expectations when the going is good, is a good management. And obviously try and judge them. So when companies start believing their own wild projections and then they make a huge investment in capacity because they are expecting, and then the cycle turns, are the worst scenario, right? I mean, where company not only over-guided you, but they themselves believed and they invested based on that, and then the cycle turns. So you have to judge a management based on its past multiple cycles, and that will throw a clear picture at you that, okay, you know what, this management tends to promise.
Got it, sir. Thanks so much, sir. Sir, in your scale framework, you mentioned that you've learned a lot of things from Sri Rakesh Jhunjhunwala, sir. So we wanted to ask a bit of personal question on that front, basically. A couple of learnings which you got from sir, and they were very contradictory to what typical generally accepted learnings out there in the market are. Any contrarian learning which you learned from late Sri Rakesh Jhunjhunwala, sir?
He used to, I mentioned one thing earlier, which is that you have to have your own independent thinking. You have to develop a mind of your own. You cannot be taking anybody's opinion. It is your action. You are responsible for your action. Neither market nor what somebody else said is responsible for your action. So be a learning machine and have your own opinions. That was something that was, I think, very different from wherever I have heard, read. There are a lot of people who used to come to him and, only ask, kya lene ka, kya bechne ka. There is no learning in that. Surely, I would rather that you ask me, ye kyun lene ka? Ye kyun ho sakta hai? You come back to me with a opposite question. This, I think there is a problem over in your hypothesis. This is not going to happen. So he used to encourage a lot of contrarian thinking in that sense. But he used to say, don't be a contrarian just to be a contrarian. And a contrarian does not mean you go and buy a stock that has fallen 50-60%. What contrarian means is you buy a business that has been ignored for 10 years, there has been zero returns, and then there is some small change which tells you that, maybe the things are turning for the better. So lot of learnings from him. One thing, again, it's a learning or rather an observation that I have, but not necessarily it applies to all of us, is that he was not only a great investor, but he was also a good trader. And I have not seen too many people who can compartmentalize their trading and investment. Most most common mistake people make is they tend to confuse their trading and investment. If they feel the market is going to go down, they tend to end up selling their investment. If they feel the market is going to end up, they over leverage and buy more than they can afford, and then they eventually end up selling. So I think that was a unique skill set of his. I have not seen. Maybe one more person besides him that I know is RadhaKrishna Damani, who is as an astute speculator as he was. In fact, he used to consider RadhaKrishnanji as his guru. So goes without saying that these are the only two people who are great investor as well as great trader. So for us mere mortals, I would say better to choose our path and focus on it.
Thank you so much, sir. Actually, it answered another question which we had in pipeline, your learnings from RadhaKrishnanji Damani, sir. Sir,
just one thing I would like to add is, besides being a great speculator and an investor, He's a great visionary in terms of identifying a good business, picking good people to run it, and building a business. That requires the next level of skill. Even I would say this is where he scores even over Rakesh Jhunjhunwala, that he built a business which is going to last a long period of time, I feel, and it has created far more value than anything else, any other activity that he could have done.
Yes, sir. Definitely, sir. Thank you so much, sir, for that answer. So we have few more questions, and unfortunately, we are on the brink of time. I wanted to check if we have some bit of time left, so we can take
3-4 more questions.
Surely, sir. Definitely, sir. One question is, how do you go about judging valuations when it comes to businesses? Like you mentioned that, as an advice to these young minds, that tracking and learning from Ashwath Damodaran, sir, something which we have incorporated in our training curriculum, obviously. But from a fund manager perspective, how do you go about looking at valuations of a business? How do you judge future growth in valuations for a business?
So this is the ultimate holy grail of investing, right? I mean, if I have answered this question, then everybody knows exactly what to do. But this is as much an art. In fact, this is the art part of the whole investing thing. While people tend to use a scientific approach to valuation or a mathematical approach to valuation, I would say Professor Ashwath Damodaran's videos are a must-see. And it is one thing for me to say that, he is gold standard in teaching about valuation, but that doesn't mean he is a great investor. It is one thing to be a good teacher and another thing to be a good practitioner. So even though you know what is to be done, doesn't mean that you'll be able to actually do it. So I think make it an act of wisdom. Don't be obsessed about getting the exact value or exact valuations right. Think one thing that I learned from Rakeshji, which was different, and that is not an approach I've seen anywhere. Don't think of valuation in terms of P and all, but think of build scenarios. Today, let's talk about it with an example that will make it a little more clear. Let's talk about it with a company. Okay, I'm not going to name the company, but let's say there is one manufacturing company. Today, we believe that India is at a manufacturing renaissance, and there is going to be a 10-year horizon. This company makes pumps, okay, or it makes compressors. Now the compressor market is about 10,000 crore. In the way the industry has been growing for the last decade, it is 5%. But based on the opportunity we see, this next 10 years could be 10%. I mean, it could be 8% or 12%, doesn't matter. You have to have broadly, whatever it happened in the last 10 years is going to happen better than that. Now, the industry 10,000 crores going by 10%, growing by 10%, and this company is going to gain market share. Why it is going to gain market share? Because it is entering from being only into gas compressors, it is going into liquid compression as well as other specialized products it is getting into. So its market size is expanding, market share is expanding, market itself is expanding, and this company has the right to win because their balance sheet is in shape, their competitors are in trouble. So if the market is growing at 10%, this guy will be able to grow at 15%. If the company grows at 15%, then there are some efficiencies that can still come about, and they will be able to grow their profits at 20%. Now, if you have found a company that can possibly grow 20% over a 10-year period, and right now, market is so in 10,000 crore market, we can become 50,000 crores because it is expanding its market and it is growing. In 10 years time, that 50,000 crore market, this particular company can possibly have a 20% market share. So which is about 10,000 crores of revenue this particular company can have. And it is available today at 2, 3, 4,000 crore market cap. Then you have to see what is the possibility. On 10,000 crore, this company can make 1,000 crores profit. And 1,000 crores profit will mean this company will be valued anywhere between 20 and 40,000 crores. So over a 10-year period, you have a possibly 5-bagger. So this is broadly how we think. You have to see if you are right, you can make 5x. If you are wrong, okay, it will not grow at 25% profit. It can grow at 15%. If it is 15%, then you end up making double your money. So that is how you think in terms of risk, reward, and valuations, rather than thinking 20p multiple, 25p multiple, and all that. That I think is an approach which has more negative this thing, because it biases you. People think 10p is cheap and 50p is expensive, but that is not the case. 50p can be fantastic businesses to buy, and they can give you multiple returns. And at 10p, you can end up losing a lot of money in a 10p stock. So think of it in terms of scenarios and opportunity versus what is being factored into the price today.
Got it, sir. So one question on the portfolio management firm. Let's say you get a really good business, and obviously at a great valuation, considering all the 4 factors which you talked about earlier. How do you go about building a position in the same? Like, do you have a thumb rule, no matter how confident you are for that business to grow eventually in future? How do you go about building a position like?
So, great question. Position sizing is very, very important. And we have some rule of thumbs, and I'll say that. So if I tick everything, so we run a very concentrated portfolio, okay? And a concentrated portfolio has its upsides and downside. Upside is when you go right, you go wildly right. But when you go wrong, there can be volatility in the portfolio. So if we get everything right, great business, great management, fantastic price, no way you can lose money, I will go as high as 15% of the portfolio I will put in that particular company. But let's say one of the two is not there. Great business, management is changing. It is not yet best management. Valuations are great, so I will not lose money. Then I will probably place a 10% kind of a bet and see it evolve. If the things are turning out better, I can increase it in future also, my bet size. The third is, it's a fantastic company, fantastic management, but the price is way out of my comfort zone. But I still want to own a little bit of it, then I might buy 3 to 5%. And then see how things are emerging. At some point in future, if I do get a chance to average up, I might add to the position. So you don't have to think in terms of a silo. Aaj ke tarikh mein kya hai? Sometimes you place bets and see how things are evolving. But then sometimes there are sitters. It's like a full toss in a match, right? If you see a full toss, you know you have to go for 6. Sometimes it's a bad luck, you can get caught at the boundary, but you have to still apply all your might to clear the boundary.
Got it, sir. Thank you so much, sir. Just last 1 or 2 questions as an advice to these young minds. Some unheard of and very impactful readings which you would like to recommend for us to read and probably grow ourselves in this investment journey.
So I am sure the known ones are, obviously you have to read Warren Buffett's investment letters, but there is one guy called Nick Sleep. He is more a private equity investor. His investment letters are a treasure. I would definitely recommend you guys look it up. There is a lot to learn from over there. There is in fact many people who are writing tremendously well. Morgan Housel is one guy of collaborative fund. I mean, he is now famous enough so everybody knows, but the way he puts it in words is, there is tremendous learning in every word that he writes.
Got it, sir. Sir, any particular mistakes which you committed in your early years of career, you would want these,
we commit mistakes even today. It would be a fallacy to believe that we don't make any mistakes. But the only thing is, as Rakesh ji used to say, mistakes to karna chahiye, but utna hi mistake karo jitna afford kar sako, and not learning from that mistake would be a mistake. So make affordable mistakes and learn from your mistakes. Make newer mistakes next time. That's all there is to mistakes. But the recent one, as I said, I was late to understanding that this pharma API opportunity was a bunched up opportunity and a very short period opportunity, while the structural thing was actually changing for the worse. The raw material prices in China were going up. and the finished product prices in US were going down. So all the API pharma companies, if you see, have collapsed badly. Because why? Because their costs have gone up and their realizations have gone down. So a double whammy from both sides. I was a little late to realize that, but once you realize, you have to admit it and get out of it. Not make the rookie mistakes of holding on to your losers.
All right, sir. Thank you so much. Sir, last one crucial life-changing advice to these young students.
Oh, you want me to give an advice? So I would say it's a fantastic field that you've chosen, investment. One lesser known thing about Rakesh ji is, and there is a lot to learn from that, is that, mortals like us, we would, if we are very bullish on the markets, we would be 100% invested. If we are very bearish on the market, we'll go to 0% invested. But Rakesh ji never went below 99% invested. If he was very bullish on the market, he would be 120% invested. If he was very bearish on the market, he would be 99% invested. So the biggest decision in creating wealth is to stay allocated to equity markets, which most of us miss. Then within that, what company you buy, how much you buy, what price you buy, when you sold, all those are smaller decisions. The bigger decision is to take a call that, I believe that equities can generate wealth. It is the most democratic way of generating wealth. I don't have to ask anybody. I'm not dependent on anybody. I just have to identify great businesses, great entrepreneurs, and great price. Bet on them and hold on to them for a long period. Very simple, not easy, but you have to do that. So take that call. I'm going to create wealth, be long-term greedy, and focus on staying invested for a long period of time.
Thank you so much, sir, for taking out time. Genuinely, we are privileged to have you here. We learned a lot from today's session. I'm sure each and every one of our students are going to watch this recording again to note down the nuggets of wisdom. We hope you give us another similar opportunity in future to learn from you once again.
Sure. We'll definitely do that. And do send the recording link to me as well.
Absolutely.
And I hope all of you enjoyed. Thank you so much.
Thank you so much, sir. I'll stop the recording here.